Hello, everyone. Mike Arnold here, co-founder of Path Trading Partners, along with Bob Iacino, who I will bring on in a minute. By the way, if you are new here, please do consider subscribing, ringing that bell, and hitting that like button. Longer-term subscribers and viewers, please do like the videos and leave some comments. And with that, sorry, I have a bad migraine, everybody, so I'm going to turn this a little more over to Bob this time. And Bob, well, see, I'm messing up everything. I'm already messing it all up, Bob. I can't
You
do
do.
anything. See, I don't want Big Mike. I want Little Mike with Bob. There we go.
Just be careful with that head.
Yeah, it's nice and shiny tonight. I got the lights on
Yeah,
a
that's
little.
shiny. Wow.
So, hello, Wavy. Day three of massive green across the board rally. Yep, hard not to be long here. Well, there's still trades within this thing. It's just if you had any trades or not. But again, in the longer term bearish market, you can still get bullish trades. You just have to be picky, and it's not, again, as we talked about yesterday, you don't just walk away for months and say, I'm just going to leave this go. It's not that time yet,
Yeah,
is it, Bob?
actually, no, I actually would like to address that hard not to be long here. There's actually something wavy that you and everybody listening should kind of, I don't want to say get used to, but think about for a minute. Not every move is your move, right? Every single day. And this is right along the lines of something that Mike has taught for a long time called candlestick math, which is actually on our Path Trading Partners website. Not every, if you look across this chart, let's start at say, oh, I don't know. Let's start at the beginning of February, right? You can go to the beginning of February and go, I should have been long here. Next day, I should have been long. Next day, I should have been short. Next day, I should have been short. Next day, I should have been short. I should have been long. The point is obvious, right? Not every single move that happens is a good idea to take part in, right? Now, I'm not saying that you couldn't have maybe acted on some sort of signal that you have on your own, and but everyone who's going to actively trade should get used to the idea that sometimes markets are going to move and you're not going to be involved. And if you sort of cave to that idea of, oh, I wish I was in this one because it's a beautiful move, I kind of look at that as you go into a restaurant, right? And I've said this in front of Mike a million times. You go into a restaurant, you eat your food, and as you're walking out, you notice somebody else has a meal you should have had as well. So you grab their doggy bag, and then you grab the other person's doggy bag, and then you grab only your meal is your meal, right? You can't walk out with every single person's meal stuffed into a big giant doggy bag because you get the shit kicked out of you on the way out of the restaurant. I don't really know where that fits in with markets, but essentially what I'm saying is not every single move is yours. And Wavy, I'm not saying this last 3 days of rally was not yours, right? I'm just saying it's very easy for me not to be long in this personally, only because I've seen a lot where you have these compression moves. You get this big down move. Oh, we hit down 20%. There's our bear market. You can buy it now. And until there's an event, again, not saying that's what's happening here, but until there's an event or a piece of data that reconfirms why we were down 20% in the first place, yeah, of course, people are going to buy those. They buy round numbers. They buy down 8%. They buy down 10%. They buy down 20% because it's been grilled into their heads that those are the moves that people expect in the midst of a bear market. And there won't be any bigger move than that. May not. This could have been the bottom. I'm not saying it's not. So anyway, I just want to touch on that. That's something we've talked about for years and years and years.
Also, we were watching for the rally this week. The oversold
Yep.
condition going into an option expiration week with a Fed week that the 25 basis point was pretty much priced in. And then you
What was
get
the level where you said we're not in beta moves territory anymore?
we've hit it. We're in.
We've had it.
If you look here, let me just get to the economic calendar. I'll go to that too. The flip was about 43.87, and that's approximate. It's not exact because you're taking different models and everything else. And I've seen models around 43.87 to about 44.14. So right in this area, we're back in going into options expiration tomorrow. We're in right at positive/negative gamma torage. There's not much additional positive or negative gamma juice at this point. Now you could get some interesting moves tomorrow because uh, any sudden moves or big moves on option expiration changes hedges drastically because of the way options can move, especially we're really close to a lot of big strikes. 4,400 is a very key area for strikes. So you could have some flipping from positive negative to positive negative gamma all over the place, and people are having to hedge and unwind hedges pretty quickly. So it will be an interesting. This is one of the biggest option expirations we've had in months. Also, economic calendar tomorrow. Where was it? Oh, hold on. Where's tomorrow? We have you got a Fed speakers. You got a couple
Four
of Fed
Fed speakers.
speakers all during market hours. So we could get some
Right.
stuff because they'll clarify that, stuff that was happened this week. I can't imagine they're going to come out with a dovish tone after this market rally and try to juice it even higher. But
Right.
we shall see, and we have these confidence board leading index month over month and existing home sales. So that
It
will.
wouldn't surprise me to see a another rally tomorrow going into the weekend,
No, it
where
wouldn't.
people are like, okay, we didn't continue. Let me cover my shorts because I don't know what's going to happen over the weekend. And then a lot of the times it moves like these, the weekend is when you get that extra piece of news that drives it lower again. I'm not saying that's what's going to happen, but just something I've seen before.
Well, also, I was looking this afternoon, and the most shorted index, which is pretty much a lot of unprofitable tech stuff, is up
Mhm.
13.5% in the last couple days.
Yeah.
Just the
Yeah.
last 2 days, not this whole rally, just the last 2 days. It's like it's in most shorted crap is up drastically. I mean, here you go. There's ARK. What was ARK in 3 days? Sorry, it's just my poster child for most shorted for a lot of crap. 21
Yeah.
21% in 3 days. Like, fine, yeah, we recover up to the top of the rotation zone. Could it even bounce higher theoretically? Yeah, it could get to the weekly rotation zone, but that doesn't change the stuff. It just means people are back to piling in. I showed last week how we're still in the buy the dip mentality.
Yeah.
And I pretty much across the board, except for a couple people, that everybody's like, "Yep, bottoms in. We're going to new
Mm.
highs this year. Bottoms in. I'm glad I bought the crap." I mean, people. I talked about people loading up on this on DD. All right, DD.
Wow.
Nothing's really changed, but they were rode it all the way down, and then they've been piling in it on every dip, and now I get no. See, I'm up huge from my last buy, not overall in my position, but I'm up huge. See, the buy the dip worked. All right, well, talk to me when DD hits zero.
All right. I'm up huge from that low.
Yeah, not the huge from here. Not the move I rode down all the way and bought this dip, 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 bought. Oh, I got one. But then it can roll over.
It's funny. I had a friend of mine who had a work trip to Vegas, to Las Vegas, and he sent me a picture of his online sports betting account that he was up $6,000. This was last week, Tuesday. And then I didn't hear from him again until today. I didn't hear from him at all. And knowing what a degenerate gambler he is, it didn't continue to go higher at all. He just sent me that how much he was up. And I actually said to him, are you actually trying to like pay off your house with sports betting? What are you doing? Like what? It's just entertainment. Okay, then why are you sending me a screenshot of your wins for the week? Are you tying your self-worth to your sports betting? And then why didn't I hear from you for a week after that? Were you not worth as much on a personal level? I don't know.
Uh,
Um,
yeah, Jay comes in. Hello, Mike and Bob. Another big day for crude. Bob, how common are 8 to 10% daily moves in crude historically?
Pretty common, believe it or not. I mean, you just go straight across from today's move, and you'll see about a 6 or a 7% move right there. You can
You
just
have one
visually see
here.
it. How
You have
much is
one
that one?
here.
Yeah, they're pretty common. And I know this isn't that same spike, but crude oil was the most volatile thing you could trade prior to the advent of cryptocurrencies. Also, remember when prices were down in the 20s and 30s, a 1% move, or I'm sorry, a 10% move is only $3. So it's pretty common. You see these huge green candles on the chart. But if you go over to when crude oil was like the average daily range for crude oil can get upwards of $5, $6 for periods of time. And crude oil is at $40, that's 11, 12%, right? You're smart to look at it from a percentage basis because obviously I think the real question is how typical is an 8 to 10% move at $100 crude oil? That's a little more rare. But 8 to 10% moves are not unusual at all. I wouldn't call them unusual, I guess is what I just said. They're not that rare.
Yeah, we had that 4 hour double. You see here now, first and second targets are hit. Next area is about this 105 area. I talked about this morning, 105. Then I'm watching 105.72. If we get a power move above there and we have the first back cross of the rotation zone, so on any pullback, that's what I'm watching. And then I'm going to be watching for actually a return to about this 50% level of the sell off, which is 112. Just speaking of
If
it,
you're wondering what was like fundamentally behind this, like why we would move this much, you may or may not have seen it, but the IEA, which is the International Energy Agency out of Paris, actually came out today with a report that said we can lose 3 million barrels of Russian crude without sanctions. Basically talking about some of the energy companies self-sanctioning and some of the virtue signaling of corporations not wanting to deal in Russia at all, and then take away the virtue signaling and just go to the sort of dangers of going through those waters with Russian crude. A lot of companies themselves have decided they're just not going to pick up shipments, running the risk that they're going to be moving with a shipment to a buyer and they're going to get sanctioned and they're going to have to turn right around. So there's been a lot of sort of off-market sanctioning that's taking Russian crude off. And that's what caused this move right here from a fundamental perspective. I suspect the 8 to 10% move or $8 to $10 move, which is basically what we saw here, is a lot of short covering. People trying to get in on a short here, thinking that for some reason we should get well below where we were prior to the invasion, which I don't know why we would get below where we were prior to the invasion when they're already invading, right? I mean, again, we talked about this before. Prior to the media actually covering the buildup of troops along the border, crude oil was up about 148%. So,
and when was
there you go.
it was the exact invasion again? Do you remember?
The invasion is 3 weeks old. Okay, so it's just under 3 weeks old. The buildup, they were talking about 2 weeks before that. So for me, they start talking about it a lot in the media. So for me, I look at from the lows of mid last year to about December or January. You're talking anywhere from 70 to 148%, depending on where you measure it.
Yeah, and then we got the round trip, but this ties into, with people I was talking to. They saw this move and up here, they were like, "I wish I was long crude." Then they were, "I'm
I
sorry, I
love that
got long
question.
crude."
That's actually, yeah, that's a great call right there.
Today it was like, and I said, "Did you watch the day's live stream? We had this on the thing," and they're like, "This up move caught me off guard." I said, "We had a double bottom on there that, it shouldn't have caught you
Yeah,
off guard." But again, this wasn't their move. Then they got in late, then they regretted getting in, and then they got out at the bottom, and now it turned around. That's where not every move is your move. Not every signal, not every tradable thing is you're going to have a signal for. We happen to, but
right.
that's just the way it is.
I love Sterling's comments, by the way.
Let's see. Let me put up Sterling's comment. Thanks for telling us how the oil company's profit margins are set. I had to explain that to coworkers who think that these high gas prices are due to price gouging. Someone should tell Biden.
Yeah, again, I don't know why the politicians aren't after Tyson Chicken. Tyson Chicken reported record profits. Chicken prices are higher. I still have this thing here somewhere. Let me find it for you guys. I wrote this down a while ago. Yeah, I don't know where it is. I'll find it before one of these live streams. But it was basically a description from my brother of how his chicken prices and his flour prices and all the stuff at his restaurant, I can't find it, had gone up. And I wrote it down. I kept it somewhere. Anyway, his chicken prices had gone up somewhere in the range of 85%. Right. And so he then was raising his prices at his restaurant 33%. He cut the hours of his workers by 25%, yet his gross wage cost still went up 11% because he had to raise wages due to minimum wage hikes and some people needing more money to keep their job. So, and again, it was all in percentages. And that's what, one of the points that oh shit, here it is. Look at that. It's sitting right here. It was literally sitting right here. So let's see. He has, and stop me if this is boring, but he had a styrofoam cup container that he used to sell soup in. And the styrofoam container for 32 ounces cost him 33 cents. The company, due to supply chain issues, not due to Biden specifically, but due to supply chain issues, which you can blame on Biden if you want, they stopped making the styrofoam container. So he was forced to go to a 32-ounce plastic container, which cost him $1.05. All right. He cut his employees' hours by 25%, and his overall wage costs went up 11%, even though he cut their hours by 25%. His chicken went from $65 a case to $95 a case. There's this baker's cheese that he uses in a specific dessert that he sells that went from $30 a case to $35 a case to now $65 a case. And a bag of flour, which was $11 a pound, I don't know if it was a pound, it was $11, is now $19. Now, if you look at those all from a percentage basis, my brother was basically watching his profit margin shrink to zero and then go negative, right? So what did he do? He raised his prices to keep his profit margin exactly the same, right? So his margins are still the same. Now, when it's a larger company, my brother owns a small deli restaurant. If you're in Illinois, Franco's Cucina in Streamwood, you should visit it. When you're talking about a big company that plans these things out and hedges their costs and all this stuff 6-12 months out, it's simply a profit margin. And the profit or their main input is crude oil. So they base it on where crude oil goes, and the profit stays the same. The margin stays the same, and it goes up. So when the overall price goes up, well, we already talked about this. Sterling gets it. Anyway.
Let's see, from Wavy, second quarter 22 Brent forecast is now 120 a barrel, with our second half 22 forecast remaining unchanged at 135 as the recovery in Chinese demand requires higher price induced demand destruction. Our 2023 forecast is now 110. So what my takeaway from all that is if Goldman thinks whether it goes slightly up or slightly down, it's going to be at an elevated range for an extended period of time. Crude's not going back to 60.
Goldman, like early this year, set their 2022 average price for crude at $100. Actually, it was 105. And I was doing an interview, I think it was on Yahoo. I think it was Yahoo Finance, where they asked me about that. And crude oil was like at $83 a barrel at the time, because I remember saying that our targets at Path Trading Partners was 93 and 95. I'm sorry, 98. And at the time it was like 93 and change. And then Mike's second level was like, I remember it being somewhere around 95.33 or something like that. I don't know if you remember that, Mike.
Yeah.
So I said those were our targets. And he said, what do you think of Goldman saying the 2022 average is going to be $105 a barrel? And I was like, I would find that difficult to get my mind around as an average for the year, unless there was some sort of shock to the system. And then there was a shock to the system. And now here we sit in March, where the high price has been 130.50, and now where are we now? About 110, 112. Yeah, right, sure. I can if we
right now.
If you believe in conspiracy theories that shops like Goldman know things we don't know, we're going to stay here for a while.
I mean, we're not going back to $60 or $70 crude anytime soon, in my mind. So whether
No,
you're
we are
in the
not.
in the 90s or whether you're in the teens again, you're up here, and the longer you stay up here, it's the adjusted average principle, is it not? You know, your adjusted
The
average.
adjusted average has got to be so. I still need to find out what that is. By the way, I saw a funny thing on Twitter today. I thought I'd bring up. A PhD candidate at UCLA, so he's a student, said that he found it funny that the working class have been priced out of homes and cars for years, but now the elites are complaining about prices. First of all, I thought, how does a PhD candidate at UCLA not consider himself an elite? First of all, how does a PhD candidate at UCLA consider himself working class? That was first. And then secondly, I thought, what I see the elites doing is saying crude oil and gasoline prices here are fine. You should buy a Tesla. That's what I see the elites saying. I don't see working class saying that. I see people like from backgrounds that Mike and I have, you know, our parents and everything, just complaining like crazy about inflation. I see it mostly coming from working class.
Yep. Let's see. Wavy also gave us some other stuff. Today's only the
Yeah.
seventh time the Nasdaq has followed a 52-week low with three straight 1% rallies. Did not know that.
Mm-hmm.
Did not know that. And there you go with that
The
Nasdaq.
question would be what happened on those 7 times?
I want to know what happens shortly after it.
That's what I mean. I'll bet you one of them was in the 2000 crash.
Yeah, I mean, there's a lot of corollaries with the 2000 crash. I was looking at something earlier. By the way, GameStop missed on their earnings, and you know the Twitter's lighting up with it's those gosh darn short sellers. Didn't we just have a rip your face off short rally, and now it's like those guys GameStop missed, and now those short sellers are back. Those short sellers are back. I'll have to find this. Where was that? If you just have any other comments while I look this up, it's interesting.
That's
But I'll have to find. I don't know where it is at this point. I'll have to find it. It's going through my stuff. But there's so many corollaries with this last couple day move and the 2000s. People were making even down to the date being the same, like in March.
yep.
It's a little uncanny, but that's just the way the markets work. When you get these sell-offs and everybody's saying,
Mm-hmm.
"See, just buy the death cross." Somebody asked me, "What do I make of the death cross?" I don't trade death crosses. I don't really
Neither do
pay
I.
attention.
I will tell you something that I researched on the death cross, though.
What'd you research?
One of the things that I found happens about 80% of the time is the market moves back up to the cross level before it collapses again. It's
That
about 75, 80% of the time. I couldn't find my research if I tried to look for it. But
now
so the death cross level, where's the death cross level right there?
is that with the
Somewhere
simple or exponential?
higher up. What's that?
Is that with the simple or exponential?
Simple 250 exponential.
That would be in the Nasdaq 5062. What I want to see though,
Yeah.
I want to see something else though, because that would be right in the middle of the 50 to 62 and a half of the whole sell-off, and
I should say it moves up towards. This would be one of those times where I don't think it would happen simply because of those two tops there, and because of the GAN levels. But it moves back up towards there before it collapses and makes a new low, and that might be what is happening now. But I found no reliability in trading the death cross in any way.
No, where the death cross. What's interesting? Let me just see where it would be. I'm moving out my levels longer term. See, the death cross in the S&P was right about 4,460.
Mm-hmm.
So
yeah, we're almost there already.
And that's the 50% retracement of this whole down move.
Yeah, it was by the way, it was the S&P I looked at, not the NASDAQ. Not to try and curve fit, but it was the S&P that I looked at.
Well, there you go. And I easily think, I mean, we just hit that 50 today. And if we didn't close yet we didn't close above the short term 62 and a half. But
Right.
that's what I was watching for, because if we close above there, I'll be watching for that tomorrow. I'd be targeting the 200 again, the 75% harmonic. and that would fulfill your little thing, which I have not studied, by the way.
That's Mike's way of saying it's probably not going to work.
No, I just haven't studied it. If I did study it, I'd give you my 2 cents worth, but I haven't studied it. It's the St. Patrick's Day effect today. What's that? Drinking green beer and buying crappy stocks.
I think
Markets.
it's the green candles he's referring to.
Oh, the green candles. The
Mm-hmm.
markets are crazy. I'm glad I'm here to trade these moves. Tons of opportunities with this volatility. GME surprise loss. It wasn't surprising. To the people who keep buying GME all the way back down, it's surprising. Well, actually, they're surprised it keeps going back down. Still not convinced to hold longs overnight, but the intraday moves are great. Agreed. And anything I'm doing is aggressively keeping stops moved up because we could get
Yep.
again. This is getting 4 hours. Is we're starting to get some divergence up here. So we're running out of momentum. We could still have that push higher with options expiration tomorrow. We'll just have to see, or it could be just a horribly choppy day, which more
Mm-hmm.
OPEXs are horribly choppy with sudden reversal moves caught in a range. But we will have to see tomorrow. And we're up against that 40. We returned to the long term trend line in the 50, and I talked about that happening. I still have my portfolio hedged to the downside. Those hedges went slightly negative today, but I'm not convinced we're out of the woods yet.
How are the AMC people doing?
AMC, based off them having stakes in a gold mine
In
now.
a gold miner now? Yeah. It's I saw something again today where somebody was like, retweet this if you're still holding AMC. And then somebody wrote, I'm holding for retirement. And I thought, you're holding a gold company and a movie theater company for retirement?
Yeah,
I'm
but it's a
super confused by
non-productive
that
gold
basis.
mine. It's not like they bought it actually a really productive gold mine.
Right.
So, this is the dip buy, dip buy, dip buy. It's going back up. I still get people telling me it's going back up to the 60s and 70s, and no, no. It's just you'll have the rallies. You'll have this. It's just like with what was it? That was AMC, GME. GME's not going back to 400 and something. GME should actually be about $40 again at this point, but
Mm.
it'll still see another 50% haircut. I will buy AMC at $3. I think you'll get your chance. I think you will get your chance again. Look at what's the long term base. The long term base. You might get $3. If you're being aggressive, the $6 range is very aggressive for any buys. But you know, this is just going to zero. But for oil people, again, not a
Mhm.
recommendation, but this is just something I noticed. XOM triggered a buy pattern today, and it's got an overhead gap, so that could be interesting for a little play, uh, for the gap fill play. But I hope that's not going to form a big head and shoulder and trigger.
Oof,
That that would be interesting.
that would be a huge one.
Yeah, but we don't have a shoulder yet. But there is a little short term potential gap play and a buy signal in there. What else? What else? Let's just take a look at what else we had. No, markets gold. Again, we got that nice bounce up in gold. Silver. Silver also very strong bounce, getting back to that neckline after hitting that first target. What do you have any thoughts on notes, Bob? 10 years?
Um, yeah, so I really have more of a thought on the curve than I do anything. Yesterday, we actually had the 5-year, 10-year go inverted intraday.
Yeah.
It's at about three. Yeah, it's at about 3 basis points right now.
Yep.
The more that you see this happening, it's like you look at the overall curve. And if there's anyone that doesn't understand the function of the yield curve, please let me know. I did a TV spot on RFD TV, which is like a rural sort of a flyover state media channel, right? And I started talking about the yield curve, and the guy emailed me later and he said, people don't really understand the yield curve, which I don't think he gives them enough credit. But the 5-year, 10-year went inverted yesterday, right? And it was, June 30th of 2021, it was at 58 basis points. The 2-year, 10-year was at 120 basis points. It's at 28. Now, twos, tens is the one that people think is the best. Actually, I shouldn't say people think. It kind of has the best recession record, is 2-year to 10-year,
which is what I have
right?
now. Yeah.
Yeah. So the 2-year, 10-year has the best record of, we've never had, I shouldn't say never. I think there's only been one time where the 2-year, 10-year has gone inverted for a period of time and a recession didn't follow in the next 12 months. Now, if you look at the difference, we shrunk 55 basis points. Well, let's say 58 basis points because it was flat yesterday. 58 basis points in that one from June 30th of last year to yesterday. We've gone what would it be? Almost 95 basis points, 93 basis points on the twos, tens. It's not inconceivable to think that the twos, tens is going to go inverted as well. And the reason I bring that up is because it can go inverted with a bullish move in the treasuries and then go inverted with a bearish move in the treasuries, and they mean different things. Okay. So if it was a bullish, and I'm talking about yield. So if yields went higher and they went inverted, that would mean aggressive moves toward inflation and lower growth in the future. If it went inverted and yields were going down, that would mean lower growth in the near term and possibly lower growth in the future. So right now, we still have fairly decent data overall in the economy that shows that the economy is doing okay. The Empire State Manufacturing Index missed by a lot, but then the Philly Fed Manufacturing Index today beat by a lot, and we got a little bit better jobless claims numbers. So we have to look over the next few sets of data to decide if the economy is really suffering that bad. But I more have a view on the yield curve that I think it's going to invert. They also asked me if I thought we were going into a depression. Something else I want to say real quick. These things have definitions, and the definitions matter. So when Mike and I were coming up, a recession was 2 consecutive quarters of negative GDP growth. Now it's whatever the National Bureau of Economic Research says is a recession. I don't know who was able to give them that power. Somebody gave them that power, and now those are recessions and those are not. But I'm still going to go with 2 consecutive quarters of negative GDP growth as being my definition of a recession. A lot of definitions in our current climate have changed. I'm going to stick with the old one. The definition of a depression is a deep recession that lasts 3 years or more, or any given year's GDP negative 10% or worse. The last one we have was 1946, where we had negative 11.4% GDP in the US. And that was right after Truman's austerity program to get us off of war spending from World War II. Right? You say what you want about Truman, but he actually cut the budget and cut spending. And it was horribly painful for Americans. And obviously a down 11.4% GDP is horrible. But then we ended up coming out of that and we had one of the biggest booms in American history. So we're not going into a depression, and I don't even think we're going into a deep recession. But I think bonds are telling us we're going into a recession. I just think yields will go higher before that happens, right? I think yields are going to go higher, and it's going to be part of the reason we go into a depression. So, but I'm not willing to say, other than technicals, when we should be buying it, when we should be selling it. I've more got an opinion on the curve going inverted.
Yeah, and that what is it? What if it goes inverted by more than a month? That's when the
Yeah, it's about a month. And it
start.
can be 1 basis point. It doesn't have to be more than that.
Yeah, but then the Fed
You should
starts.
probably answer Abraham's question because it's kind of
I
important.
will hold on. Lions with a couple super chats here. Thank you so much. ES target was perfect at 43.85. Well, thank you very much. And we'll have to
Thank you,
update
Lions.
our new targets. Thank you. Why don't option prices get inverted? How would well later date call options cheaper than shorter? That's because of implied volatility.
Also theta, right? I mean, time.
Well, the time is that's what generally makes sure if they were the same implied volatility, then your longer dated options would naturally be more expensive because there's a more theta in them. But if
Mhm.
the shorter term options are more expensive than the longer term, it's because you have shorter term options have a much higher. When that happens, they are pricing in the much higher implied volatility range than the longer term options. So they're expecting still more volatility in the short term than the long term. So that's why. Late here, but Bob, how will Fed Q quantitative tightening impact recessions probability with yields higher or lower at the end, higher or lower at the time of recession?
Well, quantitative tightening, if they actually engage in that, and just so we're clear again, these things have definitions. For them to just stop quantitative easing means they're not going to buy assets anymore. And as the assets that are currently on their balance sheet mature, they're not going to replace them. So that is what's the end of quantitative easing. Quantitative tightening is actually taking assets from their balance sheet and selling them. Okay. That's part of the reason I think yields are going to go higher and then invert. Because if they engage in quantitative tightening, they're dumping paper on the market. And it is a very similar supply and demand. I mean, supply and demand, just like anything else. They're putting more duration and more paper into the market, which is going to raise yields. And if you're not sure what that means, essentially, if I have a choice to buy a 5-year bond at 2.5% or a 1-year bond at 1%, I might buy like 2 or 3 1-year bonds, right? And so that means the people with the 5-year bonds have to lower their price, which increases the yield. And what does that mean? If something is worth $100, okay, and it has a 10% yield, you pay $100 for it, and at the end you get 110, right? But if I have this thing and I want to sell it, I say, well, give me $100 for it, you'll get 110, and you go, no, that's not enough. All right, well, give me $90 for it. You've now increased your yield on a piece of paper, on a bond. Does that make sense? You're paying $90 for it. You're still going to get 110 at the end of the term. Okay. So when the Fed is dumping things out into the market at different durations and different yields, they're going to be adjusting their price as well, just like anybody else. Now, they may force certain banks to buy them, but they can't force them, but they may recommend. But then those banks are going to dump them as well and try and get better prices on them. So it's all about them pushing paper into the market. That's what quantitative tightening is. So to answer your question, if they engage in quantitative tightening, rates will go higher than they should be at the time. Doesn't mean they're higher than now. Okay. Rates could be a lot lower than now when they start quantitative tightening, and then the rates will go back to where they are now. So it's a relative question. Michael, I hope that answered that.
Options 22. Bob, checking your temp roughly a month ago, you thought that we would end up higher on the S&P by year end. What are your thoughts now, given all the crazy events, news, data over the last 30 days?
I still think we're going to have single digit returns that are positive, and that's mainly because I don't believe the Fed will follow through. That's the main reason. So I can change that. I reserve the right to change that if they actually do follow through. But I don't think they will. I think the minute we start, if it happens, okay, again, I don't have a trade recommendation here, but the minute that it happens that the market is down 30% or 40%, let me turn it back to you guys. You guys have been around for a few years. Do you think the Fed is going to let stocks fall 78% like they did in 2000? I mean, I don't think they will. That's why I said at the end of last year when I did a recap, or I'm sorry, a look ahead interview, I don't remember who it was. I said I expected a 45% bear market this year and then a positive end of the year. Now and people will be like, oh, the bull market, America's back. It's most likely going to be, again, somewhat monetary policy driven and artificial. But if we don't get that 45, I think it'll really be ugly when we get the next one. Like, I think the 45%, based on some of the just thinking that I've done about it, might be enough to actually shake out some excesses and allow the Fed to kind of continue this experiment a little bit longer. There's still going to be hell debate, but I'm hoping I've passed away by then, personally.
What if we're still running like this 8, 9, 10% inflation?
Yeah, that's the thing. Like, if you remember what we looked at when I sent you that spreadsheet, in the times that inflation was strong and the economy slowed, they weren't able to get a hold of inflation, and that was pre-QE. So yeah, I think it gets a lot worse at that point. I think some of the supply-driven inflation can be fixed. Some of the supply chain-driven inflation can be fixed. Some of it's going to be entrenched. I mean, you can't just hurry up and make a bunch of chips, right? They're going to be playing catch up for, I think, probably 36 months on things like chips, right? Ukraine's a wild card. You can't just grow wheat, right? I mean, if they miss the planting season, they miss the planting season. That's it. So there's a lot of variables. But I don't think we'll have 8% inflation if they actually are able to go through with 4, 5, 6 rate hikes. But I still think we'll have 4 or 5% inflation. And that's when I think they balk. And that's when I think the buyers of the dips come in and push us to positive returns. But then that is going to be such a bad result 2 or 3 years from that. It's just really hard to imagine how it's going to play out. By the way, there's a little bit of cowardice on my part here too. We have so many years where the S&P finishes positive that's just always the stance you should take when you're doing a TV interview. You're just more likely to be right, so.
Why has the Fed been buying mortgage-backed securities in this market?
No clue. I have no idea. I was reading an article today that surprised me a little bit. One of the things, I'm very much a small government guy, Mike knows this, but one of the things I've been thinking about is I think the government should get involved and restrict private equity from buying single family homes and renting them. And the reason is they don't price fight, right? They'll go into a new development and say, yeah, we'll take 12 of these, right? Because they have the money. And then they have no cost of capital because they have the cash. And then they collect the rents and it's a pretty decent return on their money. And it kind of takes the individual homeowner, it forces them to pay a lot more. It's almost, if it gets big enough, it's going to create an entire class of renters, right, that can't get into the housing market. But then I saw an article today that said only 2% of houses are owned by private equity, and it's only expected to go to 4%. So it seems like maybe a bit of a false alarm there. What the hell were we talking about?
Mortgage-backed securities?
Yeah. So one of the conspiracy theories about the mortgage backs is kind of keeping a lid on that market for the individual homeowners, and to a certain degree for private equity as well, because it keeps a bid under houses. But otherwise, I don't know why. Housing's been strong. I don't understand why they're buying mortgage-backed securities. I really don't, unless they think there's something there that only the Fed can handle if it blows up. Kind of, diving on a grenade.
Michael asks, any thoughts on the credit markets? Any stress or cracks starting to appear?
There are some small cracks starting to appear, Michael. There's some spreads that are widening out. Ask me that again on Tuesday, because I actually just scheduled a call with a friend of mine who works in that to ask about some of the stuff I'm seeing. And I'm really not prepared to talk about them because it's not really my area, but they are starting to appear. And I saw them. And so I asked him if he had time to chat late this week, and he said he would. So I'll find out more, and remember to bring that up on Tuesday again, please. But the answer is yes.
Options 22 again, Bob. What are the typical crash or plunge months historically? I know October and March. Any others?
I'm not sure. I know October.
September's generally not. Starting the middle of September is when I start focusing on that. It's got to
look at it right now.
You can get some stuff in there. Wavy said the Feds will do whatever it takes not to crash the market hard, but at the same time, giving many signals that the future is quite uncertain. That's what Wavy thinks. And Rich thinks the problem is not inflation. The real problem is debt is getting bigger and bigger.
It's definitely growing, and it was shrinking during the pandemic when people were getting free money and they had nothing to spend it on. So I think you're absolutely right.
And how, I mean, the Fed can't, I mean, can we get interest rates? I mean, think of our national debt if we start having the longer term rates again at 5 or 6%.
Ugh.
How would you service it? I mean,
Yeah.
that's what one of the big caps on rates going up, really, because that starts getting to, how do you service your debt payments then? Especially in a lower GDP environment.
So according to this is liberatedstocktrader.com. So I don't know if it's accurate or not. He sources something called the Best Month to Buy Stocks book. Never heard of it. 80s, 90s, and 2000s. The worst months are January, February, June, August, and September. October is not one of the 5 worst. Weird.
But you can get some of the biggest moves.
Right. In October.
Yeah.
That's open to close on the month.
Given the current lofty and inflated levels, maybe any month this year could be a crash month. Maybe I should stay in correction instead.
Yeah, look, the last three decades, March, April, May, October, November, and December were the only months that registered positive returns cumulatively.
Which one were those?
March, April, May, October, November, and December.
So we should sit out April.
We should buy the dip in October, I guess.
Yeah, well, we could plunge going into October, and then we could get a long-term buy signal, according to you, down 45%, and then there you go. There's how it all ties together. Perfect.
Wow, according to this, from 2010 to 2014, the best month to buy stocks was October. I don't know if this guy's right.
I'm going to sit on my hands until October.
There you go.
And that's after the middle of October. I'm going to sit on my hands through the middle of October.
I'm just going to buy every dip in October, sell it October 31st, and do nothing else the rest of the year.
Sell October 31st?
No. As soon as there's a dip in October, I'm going to buy it. I don't care if I buy the low. I'm just going to buy it. And then I'm going to sell everything October 30th.
Why would you sell everything October 30th?
October 31st.
Why would you sell
November 1st? October's the best month.
Yeah, but okay, and then you're done. But don't we
for the year?
Then we're done, huh? You're done. All right.
For the year. No more trading.
There you go.
I'll be on every live stream in October telling you guys all to buy it. And that's it.
There you go. All right. Anything else before we wrap this up?
Wavy's a dip buyer.
Dip buyers of choice. Anything else, Bob?
No, I got nothing else.
All right. Well, let's wrap up this one. Again, you'll be on next Tuesday.
Yeah. Is there anything tomorrow morning that I should jump on for? I don't think so.
Let me see what's the economic calendar. There's nothing till 9, so it's just going to be. Really. We could get some from the CB leading index, but again, options expiration is going to rule the day, and then if any of the Fed speakers say something controversial to the markets.
Yeah. That's going to be after the thing, though. So that's options expiration. That's Mike's area. So I will talk to you guys on Tuesday.
All right. Perfect. Thank you, Bob.
All right, guys.
And I will
cheers,
everyone again in a few minutes. The next one will be shorter. And if you want the new levels, that's when I'll go over it again. I'm a little under the weather with a migraine. So sorry about that. Just trying to keep the stuff going for everybody. I'm trying to get me back on the screen too, but I will stick around again, and we can go through I'll update some levels quickly for anybody who wants overnight, and if we want to look at a couple stocks, it's just not going to be an extended session. So I will talk to everyone then. Bye for now.